everyone. Welcome. My name is Ismael Ray Reyes, and I'm a managing principal and founder of the Admirable Group, one of the general partners of Park Valley Apartment Homes investment opportunity you're going to see tonight. This is a great looking asset in a terrific Atlanta MSA submarket that consists of core neighborhoods with mostly higher priced homes and higher than average rents. Folks, you're going to love this deal. I'm not going to steal all the thunder from my team here. I really want to, but we're talking about a 3.48% fixed interest rate. I'll say it again, 3.48 fixed interest rate, 9% average cash on cash, and a 20% average annual return. It's phenomenal. But before we kick into the presentation, I want to set the conditions correctly here by showing you a short video of the property. Okay, so before we get into the presentation here in full, I want to go ahead and start off with a disclaimer. Bottom line, all investments have risk. Please review all the materials carefully before investing. This investment opportunity is only for accredited investors. It is a 506c, only for accredited investors. In this presentation, I'm going to introduce a very experienced sponsor team who's going to provide an overview of this project and market, dig into the business plan, answer some frequently asked questions, and provide the next steps for those of you that want to invest. Let's go ahead and jump into the sponsorship team. As I mentioned earlier, I am Ismael Ray Reyes, and I'm the managing principal and founder of the Admirable Group. I am also the president and founder of MI Real Estate. And with those two entities, I've acquired over 1,000 doors, valued at over $130 million. I retired as a lieutenant colonel from the United States Army after 28 years of service. Loved serving my country, and it was just time, right? It's one of those things after that many years, but I transitioned from there directly into what I do now, and I really love what I do now as well. It allows me to work with others, helping everyone that I work with build generational wealth for themselves, for their families, for their friends, and share that. And this multifamily business, one thing I'll say without getting too much into a tangent, it's a team sport. And I love that because it reminds me of some of the greatest times I had serving in the military, which obviously is as a team sport, where you're serving something greater than yourself. So I'll leave it there. I will talk a little bit about my team, of course, because you can't do anything without them. In fact, over half of my acquisitions has been with my distinguished partners on the slide here. And you're going to have had a chance to hear from them later in this presentation. I'll start off with Winston. Winston Schofield is a managing partner and director of asset management. He is local to Atlanta, which is key, and will be able to assist with the on-the-ground operations. Alfredo Hooker is our director of acquisitions and finance. The asset management team, one of the big things is here, our biggest focus is managing the property manager, but even bigger than that is ensuring that we give folks the proper return on their investment. That's what we're all about. That's why this is a truly passive investment for you all. So that's very critical that we continue to take a look through this asset, through the acquisition, and then obviously all the way through exit, that we study and we analyze what's going on with the financials on a regular basis. Tim Little is our director of research and analytics. Obviously that plays a role in and out of deals that we have. It's always important that we are taking a look at these markets carefully, see whether they're trending up and down, et cetera. So it's a very critical position there. And of course, Kelly is one of the central ones that have put a lot of this stuff together for us. Kelly Iannone is our director of marketing and investor relations. So fantastic team. I really obviously can't do it without them. And they keep me in line. And all of us together, we've done great. And I think that's good when you find a team that you can really work for. And we've got over 50 years of collective real estate experience. So significant experience. We've gone full cycle on 6 of 10 acquisitions that we've had in Florida, Texas, and Georgia. And roughly about 500 doors under management, and they're valued about just under $60 million. So significant experience from us here on the team, and we love what we do. Speaking of Georgia, we've done multiple recent deals in the Peach State, and it truly does have some terrific markets. Obviously, Atlanta is crown jewel. We love Atlanta. It continues to grow. It's just a phenomenal market, and we're excited to be back here again. We were able to acquire an asset late last year in Atlanta and back for more. It's just a great place to invest right now. So if you can get them, very competitive, but if you can get a deal, this is just going to be a market that's going to continue to boom. So at this point, before I turn it over to my team, I do want to introduce one of the lead sponsors, Prashar Kumar from Cash Flow Champs.
Guys, as director and the asset manager on our team, he has been doing this for almost 15 years and is one of the best underwriter that I have come across. I've done many deals with Charles and other managing partner, Ryan Murphy. Along with Charles, we have Paul Sr. He's a broker in Washington, D.C. area. He has been doing real estate for almost 10 years. He joined our team last year and is a great asset to our team. I personally have been doing real estate multifamily for the last 7 years with my personal portfolio of about 1,000 units. Ryan Murphy, independent business owner. He has about 100 units under his personal portfolio, but as I said earlier, we have done many deals together. And along with 4 of us, we have 2 junior partners, Brian Bernal and Christian Carrillo. They are the guys, they are the boots on the ground. They do everything, help us out on the marketing, underwriting, broker relationships. So they are a valuable resource to our team. Just a little bit about Cash Flow Champs. In last 7 years, we have done about 17 deals. 7 of them we have exited. Over $250 million worth of transactions we have done. And we currently hold about $146 million assets under management in various states like North Carolina, South Carolina, Georgia, Florida, Texas, Indianapolis, and Arizona. So that's about us. Let's hear from Charles a little bit more on the next slide.
Hey, Prashant, thanks so much for that great introduction. In addition to our team at Cash Flow Champs, we also have Ed Mozell from Give Me Shelter Equity with us. And for anybody unfamiliar with Ed, he's got about 40 years of experience in real estate, the last 7 or 8 of which have been in multifamily. You can see from the slide here that he's amassed quite a portfolio. So both Prashant and myself have worked with many times on different deals. Even better, which some of them are in the Atlanta market. We have a good working, functional relationship with him, and we look forward to having him be part of the team. And I'm going to turn it over to Winston so he can tell you a little bit about the market.
So we're going to touch on the market analysis of Atlanta, which is where this property sits. Atlanta, Georgia is an economic and social engine in the Southeast. For the last 5 years, Atlanta has been among the top 5 metro areas in the nation, which is like a bonus, and also has the 9th largest GDP at 602. Hartsfield Jackson Airport is the #1 busiest airport in the world, and that is #1 in the world. Atlanta also has metro tech hubs. We're #1 in that area. We're #1 in metro area for tech diversity index, and the 2nd largest Black tech workforce. The Atlanta multifamily market, since the 3rd quarter and moving forward, we have vacancy rate been at 5.4%. with a year-over-year rent growth just over 22%. The economic capital in the Southeast and global business hub, they're #2 in quality engineering, #2 in city allowed to live and work, and of course, I live here, so I love it. So I had that word in there. The #3 in metro for STEM professionals, which gives you an idea of it's not just one sector here. Atlanta's covering a vast area of employment here, which is great. Atlanta, Georgia economic and social engine of the South. Atlanta has emerged as a hotspot for corporate relocations in large regional and tech hubs. As you can see on this list here, you see Microsoft, Google, Visa, Toyota, Papa John, Walmart, Airbnb, So it just gives you an idea of all these corporations now really coming here. There's something about Atlanta or this Georgia in general where corporations thrive and they see the future in coming here. This is a list of just some of the industries and companies that are here in Atlanta. Atlanta is a major employer for Delta. This is their hub. You have Emory Healthcare here. You have Home Depot, Piedmont Healthcare, Publix, Kroger, as well as AT&T. That just gives you an idea of the type of jobs and the amount of employees they have there, 34,000, 32,000. This is just in the city of Atlanta by itself. So that's a lot of jobs, which jobs is a good thing because wherever there's job growth, there's population growth, people follow jobs. If I'm going to invest in a market, I want a market that is steady, that's been steady for over time, not just an overnight thing. This in Atlanta, but steady for a while now. And with these type of jobs here and these companies coming here, still coming here, haven't slowed down yet, is a bonus. And to add to that, we all know now a lot of other films that are being to see now. It's a big boom here as this is next Hollywood. A lot of filming and production is being done here in Atlanta, which adds to the job market. So I would definitely tell you this is a solid market. It's strong and it's a dependable market. It was able to withstand a lot of the hiccups that we go through in this any market. But Atlanta itself been pretty positive and it's been staying strong.
Hello, and I'm Kelly Iannone, and I'm going to take a few moments to walk you through the property highlights and description of this asset. So Park Valley Apartment Homes consist of 236 apartments. They're garden-style apartments, so they are spread across 15 buildings on more than 20 acres of property. The property was built in 1971, and the average unit size is 883 square feet. Now, with this property being spread across 20 acres, there is ample space for our residents to enjoy the landscape, the comforts and relaxation of the grassy areas, as well as plenty of space to go on daily walks or runs. It does sit back from the main roads and has gate access for residents for an added layer of not only security, but also privacy. And we'll talk a bit more in a few slides about the unit mix, but we have a favorable unit mix of both 1 bedrooms and 2 bedrooms at this property. Now, in this image, we are looking at the pool area as well as the clubhouse, which is located at the top of the picture. So the clubhouse in the leasing office is just above where the pool is. And you'll see those beautiful back patios that overlook the lush greenscape as well as that pool space. Now, we have lots of amenities that we'll be able to offer our residents at this property, including this pool, the green space, some great grilling and picnic areas, dog park and dog play area, as well as centralized mail kiosk, playground, as well as a gym for our residents. Going inside of the clubhouse and leasing office, here we are looking at on the left side, we're looking at the main level of the clubhouse and leasing office from the atrium, which we'll have a look at on the next page. But you'll see it's a very warm and inviting space for both our residents and prospective residents, as well as their visitors. In the lower right-hand photo, we can see some of the interior photos and the nice amenities there. This is on the main level of the clubhouse. Looking at additional photos here, again, we're looking mainly at the main level, but in the lower, we get a great view of the loft level. And I just love how there's these exposed beams in this kind of cyber cafe business office space that we have as an amenity for these residents. You'll notice that the kitchen in the upper middle has stainless steel appliances, white cabinetry, as well as granite countertops. And we'll see that as we look at some additional interior photos of the property. Again, just a beautiful property. I love the architecture of the clubhouse and the surrounding buildings. Looking at more interior amenities, the property itself is well acquainted with black and stainless steel appliances, ceramic tile and wood look LVP flooring throughout the property. And you'll notice that it's just very warm and inviting with the recessed lighting and granite countertops and really those modern fixtures that our residents would be looking for. Now, one of the things that we really love about this asset is the fact that it's really a light renovation. The current owner, the seller, has renovated 229 of the 336 units. So we have only 7 units left to renovate, but all of those units are under market value, which we'll talk to in a couple slides. So we're really excited about the opportunity to come in there and reposition the asset, mainly from a organically growing the rents. Now, some additional photos of the interior units. Again, here you can see the black appliances with the white cabinetry, granite countertops, and subway tile backsplash, tile surround in the bathtub areas, really just warm and inviting. Now, the teams were out a couple weeks ago for due diligence, and one of the things that we really pressed upon, especially with this being a 1971 asset or vintage, was we had really all of the inspections that you would ever think of for a property. We had plumbers and electricians and roofers on site, and we really appreciated how thorough they were in this process. We inspected just about everything, all the way to scoping the sewer lines. So knowing what's going on in the plumbing is so important, especially the vintage of an asset. So we did have those sewer lines scoped as well. Some additional photos of interior, speaking to the amenities. While on site, the team also had a chance to speak with some of the residents, and they really feel good about where they live. They really enjoy the upgraded amenities throughout the property, as well as the upgraded finishes within the units. Now, we spoke earlier about the favorable unit mix, and looking at that here, what that really means for us is that from a 1-bedroom, 1-bath perspective, just over 50% of the units are 1-bedroom, 1-bath, while the other nearly 50% is comprised of either 2-bedroom, 1.5 baths or 2-bedroom and 2 baths. The 2-bedroom units are all over 1,000 square feet. So really nice size units for our residents to enjoy here. And again, all of these 236 units are spread across 15 buildings on over 20 acres. So there's ample space between the buildings as well as ample parking. Now, I alluded to earlier that one of our key business plans here is to organically grow rents, which Tim will talk to more next. But we just lay out here by unit type what the rents are currently at and what our target market rent is based on comparables. So you can see nearly a $200 a unit difference on average. Part of how we get to these numbers is we really want to look at other comps in the market that are similar type assets, similar in vintage, similar in location, similar in unit mix and finishes. And when we did this, we can see on the bottom half of the screen, we have the dark blue bars are both Park Valley. The ones on the left, or the one that's at a lower rental rate, is where we are currently at with rents. The lighter blue color are comps, with the orange being the market average. So when we look at all the comps in this vicinity that would be applicable for our asset, we see that there's opportunity to grow the rents to market rate. So you'll see that we're coming right just slightly above market rate. And we just feel confident that we're able to do that, not only because of the well-appointed finishes we have on the interior units, but also the landscape and really the days and the beauty of the property itself. I'm going to turn it over to Tim to speak more about the specific business plan and how we're going to execute it and drive value for this asset.
Tim Little here. So besides being in the booming Atlanta MSA and being a beautiful property, as Kelly just showed you, there's even more to love about this deal once we start digging into the numbers. So let's go ahead and do that now. So the thing I want to highlight up front are the amazing debt terms we'll be taking over on this deal. And for anyone investing right now, either passively or actively, debt terms should be top of mind with the continuously rising rates. Simply put, current rates are preventing a lot of deals from making sense. especially when it comes to new debt terms. That's why we are to assume a Fannie Mae loan with a 3.48% interest rate with about 9 years remaining on the term. Not only that, but it has 20 months of interest-only payments remaining, which will be great for cash flow early in the deal. That rate, along with rent increases and operating efficiencies, will allow us to achieve great returns for our investors. And you can see some of those projected returns on the right-hand side. 9% cash-on-cash return, 20% average annual return, and 17% rate of return. Another nice aspect of this property is that the current ownership has already renovated 229 of the units. So this will not be a heavy lift from a renovation perspective. And again, that will allow us to cash flow and provide distributions sooner, as well as mitigate some of the risk that comes along with a heavier value add where there is a ton of renovations to be done. As you can see, we will accomplish this through a two-part strategy. Given that much of the needed renovation has already been completed, we intend to drive up income primarily through operational efficiencies. So the seller isn't really an operator. They went into this with the intent to add value through significant renovations, and they've done that. Now we're going to come in and operate it more efficiently. How are we going to do that? We're going to do it more professionally. Just one way we'll do it, we'll obviously have third-party property management in there. So we'll have experts that'll be focused on our property. And what we'll do as the sponsors is manage the manager. So we'll make sure that they are improving based on our key performance indicators, our KPIs. And then uniquely, we will also have third-party asset management for this property to, again, help us with overseeing everything that's being done and the management of the asset, right? So having that point person who is dedicated to this property specifically so that our eyes are never off of it and we always have attention focused towards it. Now, phase 2 is simply getting the rents to rates while reducing costs. Drive down costs, drive up income. That's how we make our money. All of these efforts in concert with the favorable loan terms will result in an increase in net operating income over the course of the whole period, which leads to the profits that are pushed back to you, the investor. But let's dive a little bit deeper into some of these numbers. So the purchase price you can see there, $32.3 million. And with the mortgage coming in at $25.5 million. I think it is worth noting our LTV at nearly 80%. That is something you are not likely to see on new debt. Much more common these days is closer to 60% LTV, which again can crush a deal. It's just banks are a little risk averse right now, and they're not willing to go as high as that 80% that we'll be able to get on this deal, which allows us to leverage more. And obviously that's favorable from an perspective. All right. So as I mentioned a bit earlier, in addition to the great rate we're taking over, we're also getting about 20 months of interest only payments, which, as I said, can boost cash flow early in the deal. And as you can see from the loan term, this is a long-term loan. And I think this is important to emphasize because what it does is it provides us flexibility. Although the hold time is intended to be 5 years for this deal, if we find at that point that we're assessing the market and it just doesn't seem in the best interest of investors to sell at that point, having that 9-year loan term, it gives us additional options. We are able to hold on to that deal till perhaps we get to a more favorable point where everybody will make more money. And so we're not held captive by having to sell based on the expiration of that loan, which is really nice to have. So now we're going to look at some of the sources and uses of cash in this deal. So you can see the debt again at 25.5, that's the mortgage, and the equity at nearly 11 million. The equity is where you, the investors, come in, and we do hope you'll join us.
on the uses, you can see the CapEx budget is pretty modest for a property of this size and at 1.3 million. And we will look at that in more detail here in a minute. And I know some of you may be looking at the closing costs and thinking to yourself, that seems a little high. And you're not wrong. We do have to point out that is because the numbers include the real estate taxes and insurance reserve. So if you are curious as to why it's so high, that is the reason. Then we had the operating reserves and, of course, the acquisition. So now we're going to get into the CapEx. And while modest, there's still work to be done. And as you can see, the largest chunk of it is going to foundation repairs, which are obviously important. That's something we need to take care of up front. And the next biggest chunk are those items that seem to have gotten overlooked, like soffits and gutters. Although all the roofs were replaced, paint on the outside, renovations, etc., the soffits and gutters weren't taken care of. So we're going to get that taken care of so that it doesn't cause more problems later. And of course, we intend to beautify the area with some landscaping and work on decks, patios, etc., as you see there. And as mentioned earlier, we do have 7 units remaining that do need to be renovated. So we're going to go ahead and knock those out. And we're assuming about $7,000 for each of those. As we all know, the unexpected always pops up. So we've built in about a 10% contingency as well. Again, just part of our conservative approach, and there's always something that comes up. So we do have that contingency there if and when we need it. So I just want to close out my portion with a quick recap on what is so attractive about this deal. It's in a great growing market. It has convenient access to major employers. Rent growth has been high in the area and is expected to continue to grow. And what all this means for investors is a projected annual return of more than 20% over the life of this deal. All this goes to show you that you can still get competitive returns without having to get into risky assets. With that, I'll pass it off to Alfredo to discuss our conservative approach in underwriting this deal and how we came to our projected returns. Alfredo?
Hi, Alfredo Hooker here. So let's look at the fire underwriting. Lots of numbers here, but let's focus over the important ones. On the income side, year one, we're showing an average monthly rent of $1,245. So right now, the actual numbers for the sellers today, they are at $1,133. So this is $112 bump. So with this bumps, we have comps that easily support our target. For year two, our goal is to increase rent organically as leases expires and they go to your renewal process. We will go in and effectively raise the rents. And at that point, we will see some residents leave. But also we'll see a large number of them stay because when they go online and check Google, Zillow, apartments.com, they're going to see that a lot of the competing rents are quite a bit higher. Now, within the physical and economic vacancy in year one, we have 80%. We will gradually scale down throughout the life of the investing. So we have 10% in year two, 9% in year three, and 8% in year 4 and 5. So what do we have on the expenses? We have a tax bill that's similar to the sellers now. The reason we left it at that is because property values are actually dropping. So it could be a possibility we may be able to appeal that and do better. We also have insurance premiums that give us some cushion for anybody who's been following the market in recent months. You're probably aware that insurance has been a very volatile line on the underwriting. And that's something we're giving some cushion because we want to make sure there is protection. The other expenses, many of them we left similar to where the seller is currently operating the property. The notable increases are repairs, maintenance, and turnover. The seller is selling quite a bit lower because he has been capitalizing those items. So One more thing that's important to point out, and even though you can't see it on this slide, is if we take the seller's in place income and still go with our expenses, which we adjusted taxes, insurance, repairs, and turnover, we're still north of the 6% cash on cash return in year. Let me repeat this again in different words. If everything goes terribly wrong and nothing else goes right, you still get a 6% cash in year one. So on this slide, we have the 5-year financial projections. So we're showing what somebody's investments will look like. And for this slide, we're showing an investment amount of $100,000. So with this $100,000 investments, what it shows is that in year one, you receive approximately $6,200 in cash flow. And you'll see that number goes up throughout the life of the deal. The highest being in year two. And the reason for that is because the loan has some interest only left. So by year three, we are paying the full amount of the principal and interest. And that's when you see that slide dip down over the course of the deal. You're seeing an overall return of over 100% between cash flow and proceeds. So for that $100,000 investment, you're getting an additional $101,000 back over the life of the investment. So we're all the numbers based on a 5-year hold period. We're looking at an average annual return of 20%, IRR or internal rate of return of over 17%, and an average cash return of 9%. Now I'll hand it over to Ray.
Thanks, Alfredo. We're going to go ahead and switch gears now to a summary of everything that you've heard so far tonight. And I know you've received some detailed information on the investment and the business plan, but I want to take this opportunity again to highlight a few things. This acquisition has terrific return projections. It starts in year one with a 6% cash on cash and averages 9% cash on cash to exit. It is a stabilized asset with high occupancy and low delinquency, a fantastic cocktail mix there. It has minimal capital expenditures, which means we're not going to be spending a lot of time with units that are being turned. That means that they're not rented. So that's fantastic. And it's why we're able to offer larger cash on cash returns early on in its project. And I'm not sure, I guess most of all, I'm not sure if we're going to be seeing 3.48% debt for multifamily for quite some time. That is a strong long-term financing piece there. It is the gravy on this deal. On top of that, this is a gorgeous property. You've seen multiple pictures. You saw the video. Got over 20 acres. It's ideally located near strong lines of communication in a path of progress. Again, this is a beautiful property that we are picking up at C-class pricing, but looks and feels like a B-class asset. And those of you that partner with us will have significant pride of ownership. The sponsor group is very committed to this deal with over $750,000 in hard money from day one. That's what it took. And that's what you do when you have good deals. You got to jump at them because they're very competitive. And this is certainly that. Again, a gorgeous property that looks and feels like a Class B asset. I can't overemphasize that because from everything you've seen. I think it's also important that we also highlight that we underwrote this very conservatively. And I know it was mentioned over and over. I want to emphasize that again, because there's actually some opportunities that will allow us to outperform the very healthy return projections that we've already provided, because they're highly conservative. That means that there's going to be upside. Let's talk about the first one, which is rent comps. We've got rent comps right now from multiple sources that are coming in already above pro forma. Haven't even taken over the asset, and we're already seeing that. Two, if rates push down significantly, we may be able to return some capital back to you all via a supplemental loan. And anytime we can put money back in your principal back in your pocket and you still keep the equity, that just means you have higher returns overall. It's very possible that this project's exit cap may find itself moving downward or compressing is the word, a way that you may hear this, particularly for an asset that already feels like a B class. And of course, the lower the cap rate, the higher the sales price. So we feel very good that conservative number may lead us to some significant increases in the prices at exit. 4, we've already gotten 3 insurance estimates on this property that have come in at least $10,000 below our pro forma of $186,000. If we're able to land the insurance, and of course, you can't lock in insurance until much further into the acquisition, but if we're able to lock in those rates, let's say we lock in the lower or the middle estimate, we're looking at a significant operational expense savings. That's essentially going to positively impact our net operating income. And of course, when you're able to do that, all things being equal, you're really improving the projections, the projected returns. And last, we underwrote the first year vacancy at 18%. But as you can see on this slide here, vacancy is only 5%. So 18%, but vacancy is only 5%. And we did that obviously going into this first year because we will be pushing rents. So we're going to get those rents up to market as we've talked about. And that means that vacancy will increase a little bit. It's just how it goes. But to go from 5% all the way to 18%, that's not what anybody really projected. So we're well underneath that. In fact, our property manager thinks that the first year won't go any higher than 13%. And it'll be essentially going forward from there 7%. So when you look at our numbers, we're looking at 18% year 1, 10% year 2, 9% year 3, and 8% going forward. So again, we do this on purpose because we want to make sure that we under promise and over deliver. So there's some real opportunities here to overperform. So this slide here is 2 things really in the one slide here. It's a stress test on occupancy and also an exit rate cap sensitivity analysis. Let's start off with the left table here. As you can see, all other things being equal, occupancy would have to drop below 60% in year 1 before we would have to consider bringing in additional capital or dipping into some reserves. This is well below most deals that I've seen where you're looking at a first year break even point in the low to mid 70s. So this just means that just a lot more space there for even if there's something catastrophic that we'll still be able to keep moving forward with this asset. When you look at the right table here and we talk about cap rate sensitivity, what we're really talking about is given a set of numbers, what is the IRR level up? So if the cap rate is 6%, which is what we're projecting, that means that all things being equal, we're looking at about a 17.4% internal rate of return. If the cap rate goes up by 15 basis points, then we're looking at a 16% IRR. And if it goes up by 25 basis points at sale, we're talking about here, of course, then that means that the IRR would go down to 15.2. But as I mentioned in our previous slide, that we're really very comfortable with that 6%. In fact, what we think may happen is that number is going to compress further instead of actually growing. Okay, so let's change gears here a little bit and talk about some common questions that we've got on this and the other deals, because they're pretty similar as far as what investors are really paying attention to, the keys, obviously, when they're looking at these investments. So the first one is, are we planning on refinancing? And the answer is no. The PPM does allow us to do that. So it is something that we can do. And obviously, when you're looking at these deals, you want to have multiple exit plans. You just don't know, as you're going through this, whether you're going to execute one or the other. But we do have a primary. And of course, when you have a locked in fixed interest rate that's low, it's the chances that we're going to be able to refinance into a lower rate is not very high, at least within the next 3 to 5 years. So that'd be no there. But as I mentioned, there is a possibility that we may be able to take out a supplemental loan. If the rates drop significantly, even though they may be higher, it may still make financial sense to take out a supplemental loan, give investors, you all, some money back, some of your principal back, so you can redeploy that, and you still keep the equity, of course. That's a possibility here. Second question is one of my favorites. How and when will we get distributions from operations? And so The answer is distributions are quarterly. And we're going to start distributions at the end of the second quarter from the acquisition. So 80 days later is about when we project that we'll start doing this distributions going forward. And the third question, and I already talked about it, but we'll address it again. Will the sponsors be investing in this deal? Yes. Yes, we will. The sponsors are providing, and I say sponsors, the entire sponsorship team is providing between 5 and 10% of the total equity on this deal. Currently, all in funds from the sponsor team is over $1 million. You got to figure we've got the $750 hard money plus all the expenses that have gone along from due diligence, legal, and all the things that we've had to pay up to this point. The good thing, and I always mention this to investors because it's important for you all to know this if you haven't heard this before, that your funds, your investment only gets used once we close. Up until that point, there really isn't a risk to your money. Yes, we'll have to collect that money ahead of time, but if for whatever reason the property doesn't close, that money goes back to you in full. So that's just another good thing about these type of investments is that it really does protect your downside. Because if you're trying to do this on your own, you'd have to eat all that cost as far as looking for properties and going through that process. Let's talk about the next steps here. If you're a new investor, you have to request access to the investor portal from the sponsorship team member, and register and create an investment profile. You'll then review the syndication documents and everything will be inside that portal. And then you'll e-sign the subscription agreement. And this agreement based on your profile will be a little bit different because if you're investing with cash, that's one subscription agreement. If you're investing with a self-directed IRA or solo 401k, that's a slightly different agreement. This is really making sure that we have the signatories right for these type of agreements. So once you do that, once you've signed the documents, you'll have to turn in a verification of accreditation letter. If it's been a while since you had your letter, just review. If you've got one, review to make sure that it still hasn't expired. The letter itself has an expiration date. If you've never done it before, or if you need to basically redo, I recommend verifyinvestor.com. For very little and very quickly, they'll be able to provide that letter to you, provided that you are qualified. And if you're not, you're going to know pretty quick as well. And it's obviously something that at that point, wait for the next opportunity where we have a 506B where non-accredited investors can invest. But assuming that everything goes smoothly, you'll get that letter from them. You have to turn that letter into us. You can either upload it directly into the portal or you can email it to one of the team members. And then at that point, one of the sponsors or team members will instruct you when to wire funds. And as I mentioned before, we're able to accept cash, IRA funds, solo 401k funds, or qualified retirement plan. So those are all different ways that you can invest into this deal. And then once the funds are received, actually confirm that through the portal, and you'll get a message through the portal that your subscription and your application and your investment has been approved. At that point, you're locked in. So it's important that you pay attention as you're going through this process. Make sure you don't wire funds until we tell you to wire funds. And then once you do, we'll let you know when those funds hit right away. Sometimes we can find out in 12 hours. Sometimes it takes about 24 hours, but as soon as we know, we'll let you know that your funds are there. So you'll have that. And then you can pay attention to when your subscription agreement has been fully approved and you're into. And I guess I'll segue there to one of the most important things. And I can't stress this enough. This is a first fund, first serve opportunity. So you got to complete your paperwork as soon as possible. And good deals in good markets like the Atlanta MSA here that we're talking about are very hard to come by. And there's a lot of money out there looking for good deals. And you guys know that. Those that are here, you probably have some funds that you're looking to deploy. You put it in your mattress, you're losing money. Where do you put it? So this is one of the best ways, investing in multifamily, one of the best passive ways that you can really protect yourself from inflation going forward. It's always been the case with real estate, right? So it's very important that you pay attention and you get everything done quickly so that you can make sure you're in this. If you've got any questions, obviously you can reach out to any one of us. We'll all bend over backwards to help you invest, because obviously the more folks invest, the easier it's going to be to raise that capital. And together we're able to do great things. So again, one of the things I love about this business. So at this point, I think we're done. I want to thank you very much for your interest in this deal and for your time. I hope that we were able to answer your questions. Again, any other questions, reach out to us immediately. We'll get on one-on-one calls if we need to with you to make sure that you're completely comfortable with this deal before you commit any further. And with that, as always, I want you to go ahead and invest where it makes sense. Thank you, everybody.